morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, it is Carnival Monday, or it should have been Carnival Monday, but circumstances have changed that somewhat. However, markets continue to march on to their own beat, and today we're taking a look at the banking sector again, and in particular, we're looking at the first quarter results of NCB Financial Group, the Jamaican Pan-Caribbean banking behemoth or financial services behemoth, as well as some recent developments surrounding FirstCaribbean International and that recently halted transaction between CIBC and the Gilinski Group. So turning quickly to the NCB Financial Group or NCBFG, and for that first quarter ended December 2021, the group reported an earnings per share figure of just around 8 cents TT equivalent, which was a 32.5% decline from the 11 cents recorded or reported in the prior comparable period. Now, net results from banking and investments declined very marginally, just around 0.4%, from 1.163 billion TT equivalent to just around 1.158 billion. Overall net operating income was actually up just around 1.5% from 1.53 billion to 1.55 billion. However, that was more than offset by a significant increase in operating expenses, which surged just around 9.5% from 1.07 to just around 1.17 billion TT equivalent, leading to a decline in profit before taxes by around 16.3% from 448 to 375 million, with net profits attributable to those equity holders declining 33.6% from 271 to just around $180 million TT equivalent. When we take a look at the operating income story, it was somewhat of a mixed bag. The good news is that the consolidation of GHL's activities following the acquisition continues to bear fruit for NCB Financial, NCBFG. The net result from insurance activities actually increased just around 7.5% from 368 million to 395 million TT equivalent. However, the banking activities would have declined modestly from 641 to 636 million. That's roughly a 1% decline, as did the net fee and commission income segment, which declined just around 8.5% from 295 to 270 million. That was offset by investment activities, which would have increased from 229 to 249 million TT equivalent, which was again an 8.5% increase in this particular instance. So a mixed bag, but nonetheless, there was net growth in operating income for NCB Financial Group, and as operating expenses continue or hopefully moderate in subsequent periods, we expect or we would anticipate that there would be some improvement to earnings overall. Now, one of the key factors investors should be looking at is the fact that right now you are paying more per dollar generated in terms of earnings for every NCBFG share, as is the case with the broader banking sector. And when we look at the price to earnings ratio for NCB Financial Group in this lovely teal color, which may remind some of us of a carnival costume, we can see that the price to earnings ratio would have been around 15 times over the course of 2017 to 2018. And from 2019 onwards, that has increased to 17.6 times, and its current trailing level is around 25 times, which is well above the banking sector average, which has also inflated somewhat of 22 times. So at a price of $8.40, NCB, as mentioned, is trading at a price earnings ratio of 25.1 times, which is above that banking sector average of just around 22 times. The group would have opted not to pay a dividend in the current period, and that has led to their dividend yield being, on a trailing basis, being 0%, which is, of course, below the banking sector average of 2.5%. So the good news is that the GHL consolidation seems to be paying off for now. Recovering financial markets will help the results in the coming periods, but at relatively historically high valuations and with continuing economic uncertainty to a degree, particularly for the Jamaican market, Bourse is going to maintain its neutral rating on NCBFG for the time being. Some quick news otherwise or elsewhere in the banking sector. FirstCaribbean's mooted sale of around 66.7% held by parent CIBC Canadian-based CIBC to the Colombian-based Gilinski Group has been halted by regulators, and that was announced via dissolution of acquisition notice by CIBC. Now, when we take a look at some of the details of the transaction, the Gilinski Group was going to pay the TT equivalent of just around $5.08 per share for the CIB for FCI shares, the 66.7% acquisition shareholding that they would have offered to purchase from CIBC. And that was, of course, well below the trading price of around $9 per share when this announcement was made. Since then, the share price of FCI has gradually decreased to just around $7 per share currently. And the big question, of course, is what does this mean for investors? Well, not too much in the short term. The strategy and operations of the bank remains quite sound and safe, notwithstanding the overall economic environment that they are operating in. And therefore, the acquisition or the dissolution of acquisition shouldn't have too much of an impact on the share price in the near term, at least in our view. So that's it for this week's edition of the Bourse Report. For more information, of course, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free, and catch us in the business section of today's Trinidad and Tobago Guardian. See you next week. This has been the Bourse Report.